Marty Sass has seen his share of ups and downs in the market, sovereign debt crises and stock crashes. So he certainly knows where to find the opportunity and when we're near the bottom. Marty manages $7.5 billion as chairman, CEO, and founder of MD Sass Associates. Great to have you here on Street Smart. Good afternoon.
Good afternoon. Nice to be here.
You know, it's been a rough week here in terms of traffic here in New York, no doubt. Sure. Rough weather. It's been a rough week for the markets. You've seen your share, Marty. What do you make of the dramatic moves we've seen as of late?
Well, I think the markets are appropriately expressing concern about the lack of policymakers taking action, which is much needed, particularly in the Eurozone. I was in Europe, 4 cities in Europe last week, and addressing these kind of issues, and they're really stuck in terms of lack of leadership to get together and recapitalize these troubled banks in Europe and increase the funding in the stabilization fund that's necessary to prevent this Greek tragedy from spreading and contagion to the European banking system.
Marty, that's interesting that you say that. Are the expectations that we will see a Greece default, we'll see other countries potentially default? Is that what the folks that you're talking to over in Europe are expecting at this point?
Yes. So the Greek default looks inevitable. The issue is, can they ring fence it and prevent it from spreading? Italy is a big concern.
Right.
The French banks are a major concern. There's troubled banks, 16 identified troubled banks from the last stress test, and others that are facing potential problems because of the huge debt on their balance sheets and sovereign country debt.
You actually brought us a great chart, and I want to bring it up for everybody because it looks at the current bailout program that Europe has in place versus the aggregate debt among the PIG nations. And I mean, they don't match up, and this is what we're looking right now. And basically your point is the 2.8 trillion is what's the aggregate debt, correct?
Correct.
And then the European financial stability package, I mean, that's not even going to come close.
It's 17% of the debt. It's not close, as you said.
Right.
It's obviously sufficient for Greece, but then when you move to something like Italy, there's no way. And so they've got to set up the funding mechanism to assure stability in the sovereign debt, and they need to recapitalize and inject liquidity in a massive way. And I think,
like we did here in the U.S.
Yes, exactly. It's reminiscent of what happened in the Lehman-style crisis. If we don't get injections of massive liquidity into the banks and allow them to be solvent, then we have a threat of a continued run on the European banks, a global financial crisis, a global recession, and a very ugly scenario.
Marty, don't you want to be, I mean, as long as you have the people who are running the ECB, the people who are running the EU, denying reality, not willing to tell it like it is, not willing to say what we all know is going to happen, don't you want to be short European banks and basically as far away from any risk assets connected to the continent as you can?
Well, Matt, I certainly want to be very cautious here until we see that the policymakers can come to grips with the issues.
They can't even say it.
I'm sorry, Matt, what did you say there?
I'm saying they can't even say it. You know, if asked if Greece is going to default, they can't say, yeah, Greece is going to default and we got to deal with it, you know, in this way and that way. They can't make a plan to deal with something that's going to happen if they continue to deny it's going to happen.
Right. I think behind the scenes what I'm hearing, and I was, by the way, in Germany at the epicenter of where this is happening. I was in Munich last week and Frankfurt. I was also in London and Geneva. And behind the scenes, I think the markets are getting through. And I don't want to, yet say that the policymakers are going to be able to address the issues, but the alarm bells are ringing. The hard stances that a lot of these policymakers had taken in the past are starting to soften. My most probable scenario is that although they're behind the curve and way behind the curve, and as you pointed out, many of them are in denial, they are, I think, finally going to get their act together.
And it's funny because there was some optimism that maybe that's going to happen. The European markets turned around. We've seen the U.S. markets come off their lows. We actually, Marty, caught up with Goldman Sachs Asset Management Chairman Jim O'Neill. He spoke to Bloomberg about European equities. Let's listen up for a moment.
It's a brave person that dives in there, but once the European policymakers do something fundamental to put this crisis behind us, I wouldn't be surprised to see a big rally in some sectors of European markets.
So, you know, expectations, you got to be brave to get into those European markets at this point. You, though, are not shy from depressed or distressed situations in the past. Would you be venturing into any of these European areas at this point?
I would not yet. You know, I want to see the policymakers really get a grip on it and prove that they will stand up and make things happen. I think the problem is kind of worse, much worse than we have in the United States. So here we have the horrible problem of the Republicans and Democrats fighting each other and bickering with each other, not able to reach decisions. But there, it's much, much worse. You have 17 Eurozone nations, different agendas, different bickering in every constituency there. So it's a difficult problem, and they've got to act quickly because markets aren't very patient. So I would rather wait, be cautious at the moment, keep some dry powder, line up my ducks, which I'm doing, as to what I want to buy and where I want to be, but keep a dry powder and keep a balanced approach in portfolios and be in the right kind of situations that can withstand shocks, because the worst outcome would be the policymakers blunder. They don't make the right decisions. They wait too long, and things get out of hand, and then we spin out.
We talked a lot about Europe. So you and I were talking in the break, no exposure to Europe at this point.
Right.
But you like the United States.
Yes.
Why and where?
I think this is the market that's going to go up the most and be the first to, once we come out of this. We already see the flight, obviously, to treasuries in the U.S. dollar. And I think the equity...
So much for the downgrade, right? Because that hasn't stopped.
Exactly. So it shows the confidence in the United States. So with all our problems, I think this is the best place to be in terms of the equity market.
Despite talk of a double-dip recession and people talking about slowing growth in the U.S., that doesn't bother you, Marty?
Well, it does. I mean, you know, if we're going to get a recession and we're going to get a global financial crisis, this market is going a lot lower. In the absence of a deep recession, let's just say we just go along at stall speed, which is where we are now, and finally the policymakers get in front of the curve and stop this freight train, then stocks are cheap. You know, even looking at today in our equity valuation model, we're assuming earnings are going to be down in 2012. So we're going against the consensus view of higher earnings. We're estimating $85 a share in 2012 earnings, down from 95 or 96 for 2011. Factoring, excuse me, Matt, just factoring that in, we see 20% upside, roughly, in the S&P over the next 12 months on a fair value basis. Matt, I'm sorry.
No. I want to know what companies you're buying. I want to get some names from you.
Great.
And, I'm assuming that you're not looking at companies that have a lot of exposure to Europe here as far as their sales.
For the most part, that's correct. I'm going to give an area that, Matt, is totally unrelated to the economy. So this is an industry, a wave that's going to benefit a number of different companies and sub-industry groups, and that is the wave to generic drugs from branded pharmaceuticals. $150 billion of branded drugs are going generic over the next 5 years. The big one is in November, is Lipitor, the biggest drug in the world. This has many implications. So, you know, the problems the sovereign debt countries have is partly due to rising healthcare costs, and generic drugs are going to be a solution to that problem, part of the solution. So the manufacturers, the distributors, the retail pharmacies, the pharmacy benefit managers. Now getting to specific names, in the generic drug manufacturing industry, Hospira, Mylan, and Watson Pharmaceutical.
Those you like?
Those I like and own.
He started his firm back in 1972, with $50,000. Today he manages $7.5 billion in assets. So safe to say you've done fairly well here.
Thank you.
Let's talk about what you've done, because you were talking about generic drugs, that you like that area. CVS Caremark, though, is another name you like. It's a little changed, a little bit lower on the year, but you like it. Yeah,
very much so. We spoke about the generic wave, and retail pharmacies, and CVS has the biggest in the United States, and pharmacy benefit management companies like Caremark will have higher margins on their generic drugs than on their branded. And as a consequence, we're going to see 2013, 14, 15 earnings being much higher than street estimates. So I really like CVS Caremark. It's a recession-resistant name. It's not subject to whether or not we go in a recession. Another name, just to beneficiary of the generic wave, is the largest drug distributor in the United States, which is McKesson. They make substantially more profit on branded drugs than on generics than branded. And so that wave to generics is going to help them as well.
So that whole wave of generic plays out in a couple different ways.
Exactly.
And that's what you're targeting.
Exactly.
You know, Marty, I was reading a story, I think it was back in June, and it talked about how, you know, those distressed areas that you kind of go into. You went into insurance stocks after the tsunami in Japan, and or rather the earthquake also in Japan.
Right.
You also bought oil service stocks earlier this year when they were languishing. Names like Halliburton and Baker Hughes, they've been taking a big hit since then. I think Baker Hughes is down 40%, Halliburton about the same since about late July.
Yeah.
No regrets.
No regrets. We still have profits in those stocks, although I don't like giving up any of it.
Yeah.
The issue with oil service short term is the price of oil. So as you know, all the commodities are getting hit. Oil prices in the last few days have been under pressure. And if we go into a recession, oil prices are going lower. And frankly, these stocks are going lower. My base case scenario is a stall speed economy along the lines of 1% GDP growth. If that's the case, the oil will stabilize, and these companies will do tremendously because the contracts that are coming from OPEC and elsewhere for drilling is increasing 25% in Saudi Arabia, 18% overseas generally, and these are the companies that will benefit. The thing that changes that scenario, which is not my base case at this point, is if we go into a recession and then prices go down, contracts get canceled or stretched out.
Would you sell them?
I would reduce them and in portfolios. I think long term they'll be fine, but there could be a temporary hiccup if we do go into a recession. They are cyclical companies.
Right.
Hey, Marty, you know, I think the lesson of 2009 was diversification, right? But a lot of people seem to be already forgetting that here in 2011. You run the equity side, but you have a fixed income side as well, and there's some interesting stuff you guys are doing. You have a mortgage-backed securities fund that returns 1.5% almost, which is more than the 20 basis points you get on 2-year treasuries, right?
Right. A good point, Matt. I think a very attractive sector that the Fed is supporting now also is U.S. government agency mortgage-backed securities. So we run a fund, as you point out, Matt, that has a 1 to 3 year duration, short duration. We're getting 1.5%, 1.75% yields instead of 20 basis points on treasuries. These are U.S. government-backed securities, and they're also backed by mortgages. So the spreads are wide versus treasuries. The Fed is going to support that by reinvesting principal and interest payments into mortgage backs instead of treasuries. So there's a bid under the market, and I think that's the place where conservative fixed income money should be. And I think treasuries should be sold. They're certificates of confiscation. You get, you know, 0 return on short-term treasuries. You get 1.8%.
So you think everybody who's buying is crazy?
I do. I think that if they stick around too long on a 10-year treasury at 1.8, they're going to see a loss of principal that's going to wipe out the income that they're getting. So there is risk in treasuries when rates go up. I think it's a bubble that has been overdone.
All right. Hey, Marty, thanks so much for joining us. Appreciate you spending some time.
Thank you. It's nice to be with you both.
Marty Sass there, the CEO of MD Sass Associates.